The revenue growth for the company was good, 11% odd, but the EBITDA was impacted by one, the forex loss, and the second part is that the new plant which came on stream, which meant that capacity ramp up is yet to happen, while expenses have been taken on board already. On the bottom line, they reported a loss, again, because of higher depreciation and higher finance costs. We have Mr. Mittal, who is joining in to detail the numbers, but more importantly, give us an outlook for the remainder of this year itself. Thanks a lot for joining in. Always a pleasure speaking with you. First quarter, 11.5% revenue growth. No different from what you did in all of FY25. But I remember you had said that you wanted to, see the revenue growth come by around that 18 to 20% mark. 25% of this year is over. Do you think you will get to that 18 to 20% mark by the end of this year?
Well, thank you first for having me on your show. On the growth, if you see the Q1, the domestic business actually has grown at about 22%. It's the international business who struggled a bit in Q1, and I'm fairly confident this will catch up, in the coming 9 months of this fiscal. So we still maintain we should be aiming at we are aiming at a 18 to 20% kind of a top line growth, considering the new plants, new capacities, and the markets we have. So yes, I think to answer your question, that's what we're looking for. Yeah.
So, Mr. Mittal, what are the capacity expansion plans that you have on the anvil? And for your chipboard plant, do you envisage any margin improvement going forward?
So on the capacity expansion for this financial year, we have no further capacities to be added. In fact, over the last 3 years, we have invested nearly 1,500 crores and built 4 plants in 3 locations. So at this moment, we are sitting pretty on capacities across all the product offerings. So FY26, we have no plans of adding more capacities. Our entire focus is on execution and ensuring the capacities we built over the last 3 years, they convert to revenues and profitability improves and cash flow improves. So that's the focus. On the chipboard, our sense is because last quarter, Q1 was the first full quarter we had of chipboard production. The plant's doing very well. The product quality, the quality norms, the acceptance in the market, I think is best in class already in the market. And as we move ahead, we think revenues will keep growing up and operating losses at the EBITDA level will keep reducing. Although on a full year basis, we still expect we'll not be able to be EBITDA break even in FY26. But we think as we move ahead, we'll keep improving that part of the business also.
Could you give us a sense on what kind of margins are you targeting? Because I remember the last time you joined in, you did say that laminates and plywood margins will improve or the losses in plywood business will reduce.
Right.
Veneer, which is very close to breaking even, will continue to improve. And you have, panels, which the chipboard business, which is currently loss making. You think it'll take some time before that breaks even as well. So by the end of this year, taking care of the fact that we don't have control over forex, what is the kind of margin that you're targeting? First quarter, you did about 6.5%, including the forex loss.
So on the forex, I want to say that we've had about nearly 18.5 crores of notional forex loss, which if you see the PBT, at the PBT level, and depends on how the euro moves versus the rupee. On our operational business, which is procurement and sales, we actually export more to Europe than we import. So this is only on the new chipboard plant, the loan which has been, the debt which has been funded by a German bank where there's a notional forex loss. On the margin, if you look at Q1, if you exclude forex, we are nearly at 55 crores of EBITDA. And then if you go segment wise, laminates is shy of 14%. And there are losses in the chipboard and the ply business. The plywood business losses have reduced and revenues have grown at about nearly 30% in Q1. So I think as we move ahead, I expect laminates margins to improve, ply losses to reduce, and losses at the chipboards to also reduce. On a full year basis, it depends on where we close revenues, but considering the growth targets we have, my senses will be more like this year will be more like 11-12% kind of a blended EBITDA margin across businesses. Raw material costs at the moment look stable. So if that does continue, it depends on how revenues go. So I think that'll determine where the margins are and how we close this financial year.
What about debt, Mr. Mittal? Your debt figure has gone up slightly from last year and from the previous quarter as well. Where do you see that peaking out? And do you see that peaking out this year? And are there plans to take on more debt? When particularly because you mentioned you don't have any capacity addition plans this year.
No, so we have no plans to take on more debt. This is already at the peak. And because of the Forex loss, some of the debt increases actually because of the accounting. So about 18-20 crores of debt has gone up because of the euro currency movement versus the rupee. So we don't need to take on more debt. And I think as we move ahead, the cash flow should help us, reduce some debt. And there's no plans to take more debt. So this debt level is nearly at the peak. So that's where we are in the debt position.
And what about, the thing that I wanted to understand from you on working capital, it's been disciplined despite the sort of uncertainties that we're seeing. 59 days. Do you maintain this 55 to 60 day range, or do you see any improvement from here on? And the second part is on exports. There is a fair amount of uncertainty. You had said that you're shifting focus to domestic versus exports, and the mix should be 60-40. Where does that stand at, and what's your prognosis for any sort of improvement in exports?
So your first question was on the
working capital.
Okay, yes, on the working capital, you have to appreciate that over the last 3 years we've had new businesses, new plants. So despite that, working capital has been reasonably well managed. I think more or less best in class in our industry. And I think going ahead with with our focus on only execution, we don't expect any lumpy inventory or range to come in to the working capital. So as revenues go up, our sense is the number of days will keep improving the working capital. So that's the story on the working capital. On the exports versus domestic, we export to nearly 100 countries globally. And with the uncertainty in US is hardly 2 to 3% of our overall revenues. So our sense is that export business will also grow, although the shift between domestic and exports in terms of mix will happen, but that's not because exports will not grow or will slow down. It's because the chipboard business and plywood business is largely domestic oriented. So that will alter the mix between domestic and exports. But exports will also continue to grow, and we see a positive way forward for us in the international markets too.
All right, Mr. Mittal, pleasure having you as always. Thank you for sparing time and joining us. Wish you good luck for the rest of the year as well. Numbers continue to trickle in. ESAF Small Finance Bank and